All right, let's talk about it. The world feels like it's on edge, and you can see that reflected in the markets. Today, we're going to decode how all this geopolitical conflict is basically rewriting the rules of the global economy. We're going to look at the hard data, the real-world consequences, and most importantly, what it all means for your money. So let's jump in. This isn't some abstract academic question anymore. It's real. With everything from actual wars to escalating trade tensions, the world is literally fracturing into different economic blocks. And that leaves every single one of us with a core question. How in the world do you navigate this new reality? Okay, so to understand what's coming, we first have to get our heads around the massive shift that's already happened. That stable economic landscape we all got used to? Yeah, that's pretty much gone.
For decades, we are all living off something called the peace dividend. It was this amazing period of stability that just fueled global growth. Open trade, super efficient supply chains, countries spending less on defense. Well, according to the IMF, that party is officially over. And now we're all dealing with the hangover, a new era of constant economic pressure.
So how does this stuff actually rewire the economy? Well, it happens through a couple of key mechanisms that are basically undoing decades of global progress. The first big force at play here is deglobalization. It's exactly what it sounds like. It's this process where countries start pulling back from global trade. They start prioritizing their own national security and local production over what's most efficient globally. And this, of course, makes supply chains way more expensive and a lot less reliable, a trend that got a huge push from the pandemic and has only accelerated since. And don't think this is just some minor dip. We're talking about a serious hit. The IMF's own models are predicting that all this fracturing could permanently shave 2 to 3% off global GDP. To put that in perspective, that's trillions of dollars in lost growth, just gone. It's like a permanent drag on the world's economic engine. And then you've got this other thing, financial fragmentation. Okay, imagine the global financial system is like one big, super efficient highway, where money can go anywhere, fast. Well, now, countries are building their own toll booths and roadblocks, right? They're creating these separate financial cul-de-sacs. This makes it way harder and more expensive for money to move around, which drives up the cost of pretty much everything, from international trade all the way down to your own retirement investments. So, what does this actually mean for you day to day? Well, it means that inflation that's making your groceries cost more, it's probably going to stick around. It means the products you want are going to be out of stock more often. It means more of our tax dollars are going to defense instead of, say, infrastructure. And it means the whole economic pie is just growing a lot more slowly. This isn't some temporary blip, you guys. This is the new normal. Now, this is where things get really interesting. There's this massive disconnect between how financial markets react to all this chaos and how the real economy, Main Street, is actually affected. And understanding this difference is absolutely key. First, let's talk about Wall Street. So this chart from Bleakley Financial tracks the S&P 500 right after major geopolitical shocks. Think 9/11 or the invasion of Ukraine. And the pattern is just undeniable. You see a sharp, scary dip, but then it's followed by a surprisingly fast recovery. 6 to 12 months later, the market is often even higher than it was before the crisis hit. So the big takeaway, markets have really short memories and an incredible ability to bounce back.
But see, that's Wall Street. On Main Street, it is a completely different story. For a country that's actually caught in a conflict, the economic damage is just devastating. We're talking a potential 40% wipeout of national income. And that's the brutal disconnect, right? While traders on Wall Street might see a dip to buy, entire nations are facing total economic ruin.
Okay, so with that stark contrast in mind, what are the specific, high-stakes risks that we should be watching on the horizon? Let's take a look at what the data is telling us right now.
This right here is the S&P Global Risk Matrix for 2025. It's actually really simple to read. The vertical axis shows how likely something is to happen, and the horizontal one shows how big the impact will be. That top right corner, that's the danger zone. That's where you find the risks that are both highly likely and highly impactful. Let's break down what's in there.
So inside that danger zone, we find the biggest threats that experts are watching. You've got the tech and trade rivalry between the US and China, the constant danger of a major cyber attack, the growing instability from climate events and energy price shocks, and of course, the simmering conflict between Russia and NATO. And here's the thing, these aren't isolated risks. They're all interconnected, and any one of them could trigger a global shockwave.
Okay, I know, that is a lot of risk. But the goal here isn't to predict the future. That's impossible. It's to prepare for it. So how do you build a financial defense strategy in an environment like this? Well, the answer is surprisingly simple. It's all about discipline, not drama.
This quote from Bleakley Financial Group just nails it. It says, investors should resist making decisions based on headlines and instead focus on their long-term financial goals. Honestly, the biggest mistake any of us can make during a crisis is reacting emotionally to the news. History shows us time and again it's the disciplined, long-term approach that always wins.
So here it is, the 4-step playbook for your financial defense. Number 1, maintain perspective. Remember that chart? Markets recover. Don't let short-term fear knock you off your long-term plan. 2, mute the noise. The 24/7 news cycle is literally designed to make you panic. Just tune it out. 3, focus on the fundamentals. What really drives returns isn't some scary headline, it's the underlying health of the economy. And 4, the most important one, have a plan. A diversified long-term strategy is your best shield against all this uncertainty. This is about preparing, not predicting.
And all of this leaves us with one final, really crucial question to think about. For decades, right, the gold standard for safety was a globally diversified portfolio. But now, as the world fractures and deglobalizes, what does a truly safe investment even look like anymore? That's the challenge that every single investor is going to have to solve going forward.